Welcome to Offshoot, the Fident Capital podcast with host Kevin Choquette. Offshoot is a curiosity-driven conversation that features a wide range of real estate and business professionals. In each episode, we unpack the knowledge, vantage point, and domain expertise of our guests. Then we move beyond the facts and figures and dive into the personal habits and mindset which allow them to be high performers in their respective field. This podcast's objective is simple: supporting entrepreneurs, fostering relationships, and uncovering meaningful conversations that positively impact business.
Welcome, everyone, to part 2 of my podcast with Jim Griffin. If you haven't caught part 1, please go back and give that a listen. Jim covers his history there, talks about the utilization of rate caps and how to navigate that in today's market. We also talk about some of the distress in the commercial real estate market, or lack thereof, and how to best codify some risk management practices. Either way, I hope you enjoyed this part 2 with Jim Griffin. Thank you. Swap execution. This is something that I see as another opaque part of the market. Some of the regional banks have a swap desk, and our clients will come to us and they'll say, hey, we're going to swap a rate, and I'm not going to try to make up nominal rates here, but what they deem is a very attractive fixed rate deal with a swap. The underlying, note is a floating rate note. And then 18 or 24 months down the road, they're like, hey, my swap should be worth a ton of money because rates are up 200 basis points. And then you kind of back into the premium that they paid for that internal bank execution, which proves to be really high. I wonder what you can talk to about like the efficiency of swap executions and how right or wrong borrowers can get it by not really understanding what they're getting into.
Understood, Kevin. So listeners should know this. In interest rates, a bank that is transacting in interest rate swaps, that interest rate swap and all of the interest rate swaps that bank is transacting over time are the most profitable product of any product. Many banks will make more profit on the swap than they will on the underlying loan. And it's a scenario that's very opaque to the borrower in terms of the fees the bank is making. How do I know? I used to be the guy clocking those fees at the bank. That's how I know.
Yeah.
So it's not a bad thing. This has been in existence, for decades now, and is a useful tool for the bank to accomplish a couple of things. One is it fixes the rate for their borrower. So that borrower has known interest expense, of course, meaning it synthetically turns a floating rate loan into a fixed rate loan. It also allows that bank to maintain floating rate assets on the bank's balance sheet, which the bank likes. And if you don't really know what I mean by that, remember Silicon Valley Bank, First Republic Bank, that had lots of fixed rate assets on their balance sheet. Not good for a bank to have fixed rate assets on their balance sheet. Best practice is floating rate. So floating rate loans combined with swaps, again, allow that bank to accomplish a couple of very good things for themselves: profitability, fixed rate for their borrower, and floating rate assets on their balance sheet. The issue is, as I mentioned, it's laden with fees, and those fees can be significant for the borrower without the borrower even realizing it. So many banks easily charge 10, 20, 30, 40 basis points in fees in a swap, frankly, without borrowers even realizing it. And how does that manifest? That goes directly to the fixed rate that they receive or establish by executing the swap. So if I'm a borrower and I have a lot of knowledge around interest rate swaps, and I'm getting these fixed rate pricing indications from the bank as I'm proceeding toward closing my floating rate bank loan, and I plan on executing that swap as the bank is asking me to, any negotiation of that basis point fee, again, reduces the fixed rate that I end up with. So if their swap profit is, say, 40 basis points, and I can cut that in half to 20, that lowers my fixed rate by 20 basis points, directly. So the issue is many of the banks, most of them won't disclose what the basis point fee is to the borrower. It's just, here's the fixed rate. Do you like it? Great. Let's close the loan and execute the swap. So it's very opaque to the borrower most of the time. So really the only way borrowers would really know that or understand that or really allow them to get a real handle on the fees that they're being subjected to is to frankly just hire somebody like us and allow them to construct that fixed rate into cost of funds the bank incurs by lending, plus determining what we call the swap spread is, that 40 basis points that I've been describing. Not a difficult calculation, but definitely not one that really any borrower in commercial real estate in the middle market can really understand or do by themselves. Then it's just a question of if it's, fair or unfair to the borrower, getting some expertise that allows them to negotiate that fee lower.
And as soon as you guys are at the table, is it sort of party's over for the bank? Are you effective in saying, hey guys, you've got 40 basis points premium in here. We'd think that 20 is commercial.
We usually are very effective. However, remember, Kevin, that the bank is taking risk in the swap. They need to make money. So we don't go in with a baseball bat on behalf of the borrower and beat that bank's interest rate swap desk up too bad. We know what's commercially acceptable, and they know that we know. So it's not a difficult conversation usually. And usually once it's found out that we're involved with the borrower, oftentimes the fixed rate quotations or indications suddenly improve, if they were wide initially.
Yeah.
So again, we don't go in and beat up the bank on the spread, frankly, or the swap profit, because the borrower needs the loan. There could also be a real relationship that borrower has with the bank, right? We don't want to endanger that or mess that up just based on one swap transaction. But it's just a conversation around what's commercially feasible and acceptable, something we see based on the risk that the bank is taking, and then trying to negotiate as close to that as we possibly can. So really, it's a question of opacity for the borrower. They really don't know what they're paying. And if it's excessive, which frankly, Kevin, in engagements like that we have, is it excessive? It's excessive maybe half the time, to be honest, not all the time, in the bank's defense, frankly. But oftentimes it is excessive. That's where we can definitely add value to borrowers in that case. There's another scenario that we see too in commercial real estate, specifically with mortgage bankers, is that they really don't have a real understanding on how that fixed rate is manifested. It's the fixed rate through a bank loan and a swap, or a fixed rate they're looking at on a life insurance company term sheet. Really anywhere that quote unquote fixed rate shows up, they really don't have any sense of how that's derived. So we do spend a fair amount of time in our hedging 101 presentations that we do almost daily to different parties in industry on explaining things like that and how to really understand and have the ability to truly compare, say, a fixed rate term sheet versus a floating rate term sheet combined with a cap or a swap. And why is that important for a mortgage banker? Well, it gives them, greater insight and allows them to advise their borrower client on financing a whole lot better than just saying, this is the fixed rate and this other fixed rate is lower, so let's go with that one. Maybe not. So there's a little more to it than I think most people realize.
And are you just referencing the underlying index and what its spread is over the index, or is it
essentially?
Okay.
Essentially, okay. Kevin. So instead of index, it's more what is that lender's cost of funds as an organization, as a lender, and then what spread on top of that are they adding to result in the fixed rate that they're offering. So really what it turns out to be is a comparison of credit spreads
Mm.
between lenders and which one is more competitive. Because not all banks obviously have the same cost of funds. They have different deposit mixes and whatnot and different ways of funding themselves. But it's essential just from a conceptual basis at the very least for mortgage bankers to really understand where their fixed rate comes from and at least start an understanding of comparing credit spreads, what that lender is truly charging to make that loan.
So if you're, I'm just going to make up names here, Prudential, Pru, Symetra, some sort of life co, you guys are going to the underlying credit and then establishing what their likely cost of capital is, and then seeing the spread that they're charging to get to a coupon that might be the same to the borrower.
Essentially, yes. Of course, I would never or could never call those lenders and ask them, hey, what's your cost of funds?
Right.
They're never going to tell me that.
Right.
Right? None of them would. So you sort of get to an approximation of what their cost of funds is. And then you compare that to the fixed rate. The difference is the credit spread or the markup over their cost. So that involves, obviously, there's no hedging involved in that line of thought or anything like that. It's just understanding interest rates, frankly, which are, I would argue, the blood of commercial real estate. Frankly, there is always debt of some sort, usually, most of the time, and really understanding how interest rates work. And that's part of that understanding is understanding where the fixed rate comes from.
You said we could sit here for a month. I won't make you do that, but I tend to agree with you. There's a lot on the table. There's a couple other applications of this middle market operator that maybe we could talk about, where I suspect you have more than sufficient expertise. Right now, a lot of folks are doing buy downs of rates, and we had a quote come through the other day. 2-point buy down was equating to a 38 basis point savings over the 5-year duration of the loan. How do you guys think about, I have a way, I don't know if it's the right way, but how do you guys think about assessing the value, the economic value of paying 2 points to save 38 basis points over 5 years? Or, a different scenario, 1.5 points to save 38 basis points over 5 years?
Well, remember, Kevin, we do everything we can, frankly, to stay out of the financing analysis, to be honest. That's your job.
Yeah.
And we do not want to overlap with the likes of you. Why? Many of our referrals come from mortgage bankers, right? Brokers. So we are very careful about usurping their value add to their borrower client. So if we do get involved in something like that, I'm not bailing out on you on that question unjustifiably, but if we are involved at any point, it's just us sort of helping the mortgage banker to understand it such that they can present it to their borrower.
Yep.
But we absolutely are completely separate from, we do not source financing. We don't really spend a whole lot of time analyzing financing sources and the competitiveness of one versus the other. And that whole understanding fixed rate derivation conversation we had a minute ago is really just helping the mortgage banker understanding and being able to compete, in terms of the value add to their borrower. So we don't do a lot of that, frankly, Kevin, to answer your question.
Okay, fair enough. Let's switch a little bit to the business. Like you're running the business for 11 years now of Derivative Logic. I understand you have 8 people on the team. How do you think about scale? Meaning, trying to add headcount and pick up larger market share versus staying small. What is it that's gotten you to this size team?
Just growing rapidly over time and needing qualified folks to just assist with the flow, to be honest with you, Kevin. We talked about the esoteric skill set, right? That is financial derivatives. Almost every single one of those 8 people, 7 out of the 8, worked for large banks for years and years, just like I did. So they went from, working for a very large banking organization to wanting to do something different, kind of like I did way back when, and that's why they're here, because they're able to just sort of relax more and be more creative and all those things and reasons that I gave you earlier. But as well as I do, it's very difficult to scale a consulting business.
Mm-hmm.
So we employ different sets of technology that frankly disrupt part of the advisory service that we offer in the name of scale or for the effort of scale. So it's sort of a scenario where the technology we have is combined with our advice that we give to give the client kind of a better, more efficient outcome than talking to Jim for 2 hours on Wednesday afternoon to explain interest rate swaps. You know what I mean?
Yep.
So, because everything we do, Kevin, is in the weeds, everything. Like that's where we operate, in the weeds, with the numbers. So there is a way to not automate, but sort of create tech that allow the borrower client to self-serve, or frankly, the lender client to self-serve part of what we do. And we have tech that allows us to sort of do that more and more all the time. We'll never completely disrupt our advisory offering. It's just impossible because people don't like that anyway, frankly. They like to talk to a person or not necessarily trust a number that's spat out from a model. They want some context for that number and where could it go and where's it been and what's your view and that kind of thing. But if there's any hope of scaling a consulting business, you must disrupt part of your advisory offering in the name of scale. So that's what we do.
If it's steps 1 through 10, rather than starting with everybody at 1, you're trying to leverage some technology that maybe lets the client get from 1 to 4 on their own. They're more highly qualified by the time they get to you. They're more knowledgeable, and then you've eliminated some percentage of the kickouts that would have dropped out in step 2, 3, or 4.
That's exactly right.
Yeah, that's
so
clever.
It's not really anything you're going to see much on our website and whatnot, because it's stuff we created, completely custom, that we built. And it's usually the life cycle of our tech, it's once the client has been a client for a bit, that's when we start to introduce it, because we've educated them to a point where they can use the tech, versus if they've never purchased an interest rate cap before, or never borrowed floating from a bank and transacted a swap to fix the rate, the technology is not going to make a lot of sense to them. So we have to get them to a certain level to where they can use it. And that's kind of the business model at this point. But in terms of weaving tech through our advisory service, it's an ongoing project and process, and will probably never end.
And for you guys, I was going to ask this, and you just sort of brought me right there. What is the transition where you have a client versus a deal, and how does the posture shift, and when does it shift? So it sounds like you have both, right? Same as us. We'll take a transaction, happy to do it. Much prefer to have clients.
Exactly. I'd say probably half of the brand new clients that contract with us are coming to us because they must transact for some reason. It's a floating rate bank loan with a swap, or a bridge lender that's requiring a cap and whatnot. And they pretty quickly see, based on our value add in that transaction, that they want to know us and talk to us more. So even after that initial transaction is over, they come back to us over and over and over again, because they sort of want to have an expert at their fingertips, or have a resource that they can ask questions to, either on a generic or a specific basis, that's going to give them the right answers and isn't going to charge them for every minute of the conversation like an attorney would. So probably like you, Kevin, frankly, probably half my day is getting phone calls from people I kind of know or don't know or may know, where there's no transaction at all that I'm engaged in. They're just calling me or emailing me to ask me something because they saw something, and is this for real, or does this make sense, or what do you think, or what do you think we should do? And then, as you know, once you continue to offer real value to people, they stay with you, or they eventually transact, or they eventually engage. So it's not rocket science. Lots of people have that business model in business, and that's definitely ours.
I like it. So let's transition a little bit to the personal side here. But what was your goal? I mean, you gave a good background as to how you got here, i.e., you were sort of hobbled at the banks from providing the kinds of services that you had historically provided your clients, and chose to go out on your own. But what was your goal in doing it? Like where were you hoping to build this to, and where do you want to bring it?
The goal upon establishment or creation of derivative logic, frankly, was the client relationship.
Mm-hmm.
So when I was at the large banks, sure, I had clients and I thought maybe they were my clients, and they were to some degree, but they weren't really. They were the bank's clients, right? Meaning if I were to leave that bank and go to some new shop and call that client and say, hey, it's Jim Griffin, remember me? Hey, they at least half the time, if not 70% of the time, those quote unquote clients would say, yeah, Jim, it's great. It's been great, but I got up all my money at UBS.
Mm-hmm.
Or I've got all these loans from these one or two banks. I got to transact. I got to listen to them. I can't. And I understand that, right? So the point being is they're really not your clients at the end of the day. But when you're an independent advisory firm, they are really your clients, meaning they can call anyone they want. And I don't hold their assets here or lend money to them. They're clients and repeat clients because they are doing so based on the value that you give them, which is a nice feeling. So I knew that going in, and that frankly was my goal, to have a portfolio of clients where we truly had a relationship, a value exchange between us. And that is absolutely what we have today. Fortunately or unfortunately, I'm kind of a workaholic, and I can't really imagine ever retiring, ever. Meaning, if I became a trillionaire suddenly because I, called the 10-year treasury yield right tomorrow and put a big bet on it, I always have to do something. So sure, what's the end game for derivative logic? I don't know. A sale, some kind of buyout, a transition to employee owns, and I piece out whenever.
Mm-hmm.
But I don't really see that happening probably ever. Frankly, I'll probably drop dead at this desk at some point. Sad to say, if you ask my wife, but it's probably true. And frankly, most of us at Derivative Logic feel the same way. We have sort of a combination of salaried employees, and there's maybe a couple that aren't salaried and need more freedom to do other things. But yeah, I really enjoy what we built, and our client relationships are the lifeblood of what we do, and it's just really enjoyable, benefiting people's lives.
I can imagine you're in it. You're in the day to day. You're block and tackle. If you take a moment and think back to you and Rex starting this 11 years ago, and look at, like, I have to imagine there's quite a bit of distance traveled from, okay, we're going out on our own, to where you're at now. What's the experience of kind of looking back at that?
Well, one of the first memories that I have is we were going to, because I'm in Northern California, but have a long Southern California history and New York history. But one of my first memories that I can recall literally in the early days is Rex and I, we were going down to Southern California driving because we didn't want to spend money on airfare to Southern California. And it was a really early morning because, we just chose to leave at, 2 or 3 a.m. You know how that goes if you've
Yep.
ever driven, say, from San Francisco to LA or Orange County. So we're driving, coffee, and I look back and Rex is curled up in the back seat asleep, right? This is not a guy I've known for very long, right? Maybe a year. And it was sort of two memories, like one is like, oh my God, what am I doing to this guy? But then on the flip side, it's, we're doing it. We're going to be successful no matter what. And I'm sure you'd agree, Kevin, it's really just that incremental daily chipping away toward your goal that really is the secret sauce. It's just a daily, not grind, but, just daily micro goals work every single day that we all know already. We may know it, but lots of folks don't do it. And we definitely did that, and frankly are still doing it. So it's just something I've always enjoyed, that kind of dynamic. Of course, as you get older, you can't always hack it to that degree, but so far so good.
You might buy a ticket this time and just fly down.
Oh yeah. Yeah. We haven't driven in a while. It's been a while. It's been a while. Yeah.
And
So,
maybe
yeah.
you just gave me the answer, but I wonder, is there any, maybe not big-ist, but any one or two lessons that you think you've really kind of have been brought to you on this journey of kind of going solo and being successful at it?
I think the biggest thing um, to a consulting or advisory type of business is integrity.
Mm-hmm.
Um, as you probably have seen in your own work, there's been many instances where we could have maybe skirted the lines, maybe made bigger fees or done this or that, and we never have sort of entertained those offerings or thoughts, and we never will, because frankly, in the long run, it's just not worth it.
Yeah.
So we have a sterling reputation in the marketplace. We take that extremely seriously. It's very important to us. And that integrity, frankly, has resulted in, maybe slower growth sometimes, maybe a lower fee than could have been achieved, or a lost client, or things like that, because it's just something we don't do. And really, I'm blessed with an excellent founding partner in Rex Evans. So he and I have been of the same mind and that integrity, respect, and others from day one. And one thing my father told me, who was pretty successful in his own business, never have a partner, right? We've all heard that.
Mm-hmm.
And I was a little scared in the beginning to have a partner, but man, we've really done it together. And Rex is just the world's greatest partner. Couldn't have done any of it without him, and he continues to be that way and has that same extremely high level of integrity and work ethic, frankly, that I have.
Do you
And I'm
find that
grateful.
you guys have unique skill sets that are complementary, or are you quite similar and think the same and kind of execute the same?
No, we definitely have different skill sets. Do you want me to outline what those are?
Well, I don't know that you need to outline, but
I don't
I
think so.
wonder, sometimes the friction is positive, right? Sometimes having somebody who's OCD alongside a guy who's ADD actually can work out, right? Where there's one guy flying around with all these ideas and chasing all these squirrels, and the other guy's looking at him going, "Hey, you're crazy. And oh, by the way, we still need to get this done." And there can be some superpowers in that. I just wonder if there's any dynamic like that between the two of you.
There is absolutely a dynamic like that. So we both have the big ideas and the strategy ideas and whatnot. I'm probably a little bit more of a better grinder than maybe Rex is, but he's very good. Frankly, also, Rex has much deeper market experience and product experience than I do, believe it or not, meaning he was in the derivatives game 12, 15 years longer than me. And believe it or not, that's valuable. So there's many times where I'll be looking at some transaction, some derivative, and I'm maybe stumped or aren't seeing something, and Rex will come over my shoulder and go, boom, see this? And it's like, to let someone turn the lights on. So he's, very, very additive in that respect, among others. But I would say overall, to answer your question, Kevin, we're pretty similar for the most part. Rex has more cycle experience than me and
Mm-hmm.
can come out of left field with some really positive ad there. I can be probably more the automaton in terms of just working too long, maybe doing too much, meaning it turns out to be helpful in the end, but in the moment can be maybe even sometimes abrasive because of
Mm-hmm.
focus. But both of those skill sets, among others, that we work very well together.
So I'm going to go back to this thing you just mentioned about, like, hopping in the car, rolling out at 2 or 3 a.m. and going down to SoCal, which is to say, at that point, you're betting everything on your success. You're 11 years in. You guys are, I'm pretty confident, doing very well. How do you manage the change in, waiting for the phone to ring, to what you just said a few moments ago, where the phone's ringing all the time and there's maybe too much inbound flow, and you've got a completely different challenge. How do you deal with being on the other side of success and all of the inflow?
Really just having more resources to put toward it. And that's, again, people and technology, the tech to sort of do the beginning stages of, say, a specific transaction or consultation. More individual people, obviously, to take on some of that extra demand. Obviously, those people having the same or even more expertise than me, given realms or subject matter.
Mm-hmm.
But really, the biggest challenge is maintaining the service level and the quick responsiveness and things like that.
Having the right people on the bus.
Correct.
Yeah.
Correct. And I would say, I don't know if you've had to deal with this, just from a management perspective, the people aspect is the most difficult. It is
I've heard
very
people say
difficult.
business would be great if not for clients and employees.
Yeah, the people
Yeah.
aspect.
It's always I mean, that's the joy and the challenge for sure.
It is, and that's where the style comes in, and the whatnot, and really more than anything is keeping the ego in check. That's
Yep.
huge. So
Yep.
we don't really have any egos over here, or at least try not to. And if one shows up, I think we all kind of rely on each other to call that out. So because that's just
Uh-huh.
counterproductive in the long run.
What about the end of the day? What do you do to kick your feet up, and when you can make yourself not be a workaholic, what did you find relief?
So my sort of personal habits or hobbies have changed over time. In my 20s, I was a professional skydiver and like avid scuba diver and rock climber and surfer. A lot of those things have gone to the wayside just as I've aged. It's just harder.
Yep.
And I have teenage kids, and my son, who's 19 now, about 5 years ago, picked up the guitar and is quite adept and skilled, and I did with him. So
Nice.
I would say sort of an equal hobby to the outdoors and surfing and those things is playing the guitar in a band. So I'm in a couple of bands, and it's the typical tacky stuff where I'm playing at a winery or a wedding or something like that, and there's 30 people in the audience, and sort of silly, but it is really fun. And by the way, anyone listening, if you're looking for something to pick up as you age, something you will never master, pick up the guitar. It's
Yeah.
quite a hobby to take up.
That's great. I don't want to keep you too much longer. Any message you think for an aspiring entrepreneur? Obviously, these middle market guys are some of them. There's also people in other segments of the real estate industry, be they service providers or vendors or builders. Just any thoughts you think you might want to pass along to the aspiring entrepreneur, or even the one who thought they were doing everything right and now the market's turned against them and facing some significant headwinds.
Well, I'm probably not going to say anything that's new, but for me personally, it's having a very large goal, visioning myself successful in achieving that goal, but backing all of that up with micro habits that I'm executing every day and showing up in the executing or the working toward those micro goals and good habits every day. That's absolutely critical.
What I don't want to drag this on, but that's too interesting to let go. What do you mean when you say micro habits? How does that show up for you?
I meant micro goals when I said micro habits. I'm sorry. Micro goals in that, if there's some new line of business that I think should be in, committing a certain amount of time and having a goal of that time commitment and investigating it as an example to learn about that line of business and not letting anything else get in the way, even if that means working an hour longer or whatnot, actually committing to a plan like that and investing the time to do that.
Chipping
Uh,
away at it, like you said before.
just one example of a micro goal, because it's easy to envision the success that you're reaching for, through your mind's eye. That's very important. Visualization, but even visualization without true work and working toward those micro goals daily is nothing. You got to have both,
Yeah.
and that's just it. Just having a plan, micro goals, not sort of drifting day to day. Oh, I'll get around to that or this and that. That's just a killer. I've been there. I've done that. I regret things, laziness that I've had in that regard. So just for me personally, the micro goals are critical.
I dig it. Jim, thank you so much for taking the time. Listeners, thank you for tuning in. Derivativelogic.com, is that the domain for you guys?
That's it.
Okay. Yeah. And you guys can find how to get to Jim through there quite easily. Jim, I'll leave it for you for anything you want to say on the close up. But thank you again for your time. I really appreciate it.
Thank you, Kevin. Really appreciate you having us and me on your podcast.